And that, in my view, it creates another like centralization pressure. Like if only people who are like highly like specialized, who have the capital to lock up all of these coins, who have the like expendable liquidity, then it will just be a small group of people. And then like the question is, how is this different from the current banking system, where like banks like have these payment channels between each other, and you just have all of these intermediaries, whereas with Bitcoin you can send money from person to person like directly by just broadcasting a transaction on the network.
Well, but you can still do this with Lightning as well. That is a huge difference, right? Is like you don't need a huge amount of liquidity to use Lightning at all. It just
I don't think that's true. What's up, guys, and welcome to another episode of the Tobias Ruck Podcast. Today I have with me Jake, a BTC fan, and we talk about Lightning versus on-chain scaling, specifically Bitcoin versus eCash. We also talk about Avalanche on eCash and Ethereum and CBDCs. So very interesting conversation. I really like these kinds of conversations. If you like that kind of stuff, I highly recommend to go to the Electronic Cash Conference in Prague, 26th to 28th of August, where we can have these kinds of conversations in person. I've just been at Mallorca Blockchain Days, and it's so much better than anything we can have on Twitter, on Reddit, and so forth. So highly recommend that. If you can't make it in person, we try to approximate it as much as possible. Like we replicate the venue there. You can walk around, you can video chat with people right away. We got online tickets for that. Until the end of the month, you can use the promo code RUCK to get 21% off. So go to 2022.be.cash and enjoy the episode.
This meeting is being recorded.
That's funny. Okay.
All right. Hello, everyone, and welcome to the Tobias Ruck Podcast. I got here with me Jake, and maybe you can introduce yourself, and then people know who you are.
Yeah, I'm Jake Hamilton. I'm a crypto dev, Bitcoiner, but I've done a lot of work in like Solidity and DeFi as well. And I'm also an Urbit developer working on Urbit Lightning Network integrations. I sort of ran into you guys via a Bitcoin group in El Salvador this past week, and heard a little bit about eCash and what was going on, and just wanted to find out more. So we set up this call.
That sounds great. So let's talk a little bit about Bitcoin. So how did you get into Bitcoin? Or was like Bitcoin your first like crypto project that you got into? And how was the history there?
Well, so I first heard about Bitcoin, early like in 2011, 2010 or something, but didn't know, I wasn't a dev at the time. I was studying philosophy in college and just thought it sounded cool, and I'm glad I don't know how many Bitcoins I spent on acid, because I'm sure I would deeply regret it were I to know it now. But I ended up taking a Bitcoin and philosophy like post-grad seminar in 2015 and realized
philosophy.
And realized it was actually like an epochal technology that was going to change the world and the way we operate in it, and decided that I was going to quit trying to go to grad school in philosophy and pivot completely to being an engineer, and because this is what I wanted to work on.
Awesome. Wow. Yeah. It's interesting because, Bitcoin has such a rich philosophy, and people don't really understand that too well, because at the end of the day, Bitcoin is more of a social project. Like it's not really about the code. It's not really about everything. It's about, what is in people's hearts. What do people believe? Right. Like I treat Bitcoin almost more like a religion, right? Like you can see that like the religious fervor people have, and like how there's
because it depends on like how we relate to the future, right? How we construct our relationship with time and value and society. Like that's the epoch changing thing. And then everything else is, implementation.
Yeah. So so what specifically do you like about Bitcoin, and do you think that on-chain scaling is a viable solution, or should we opt for a second layer solution?
I'm a second layer person. I think that I think the function of an L1 is to provide a minimal criterion for reality that other things can depend on. And that if we want to make that its ability to provide, a criterion for what's real and what actually happened as robust and reliable as possible, which is also necessary to like initiate and sustain the feedback loop of confidence that gets people to use it and therefore makes it profitable to mine, and creates a stable asset that has a monetary premium that will persist into the future. That it needs to be as minimal as possible, while providing like as wide an array of options for what you can do with it and what kinds of things that reality criterion can secure as possible. And so this is what I like. I mean, the small block thing, it's great that it makes it easier for people to verify, and like all of the reasons that we opted for small blocks make sense. But what I think is really cool about it is that it's a generative constraint, right? Like the reason Lightning came to exist is because it forced people to get creative with like doing more with less. We realized that like a UTXO isn't just like a most recent direct one-to-one person payment. It can be this whole other ontological level of thing. And so we invented layer 2 for that purpose, and driving that kind of creativity with like reimagining what a UTXO can be, I think is like a very bullish sign for the entire small block proposition.
Well, not just a small block proposition. Like I work on eCash, and we have a protocol. Like we have the same structure as Bitcoin. Like we're functionally the same, only have bigger blocks, and we're also working Avalanche pre-consensus. But we have like we do a lot with UTXOs. So we have the OP return output, and there what we do is we put token information. So that way you can put like stable coins, you can put like some kind of other token on there. And that's all possible on Bitcoin too. I think it depends on the size of the OP return, which I think is bigger on eCash. And also like we have quite powerful smart contracts, like actually just with one opcode, OP check data sig, which I think BTC is also thinking about adding because it's just so powerful.
Which one, sorry?
We call it op check data sig verify. So it's basically on Bitcoin, I think they wanted to call it check sig from stack. So it's basically like check sig, only like it has to be like the signature, the pre-image or like the hash of the pre-image of the message can be on the stack. And
right, and so you have a covenant without like direct introspection. Yeah, exactly.
You can it allows you like very powerful transaction introspection. So you can build games, you can build.
I think it's live on Liquid, isn't it, as well? Check sig from stack.
I don't know. I liquidated my liquid coins, but yeah,
yeah. You can do some crazy stuff with it. I saw a demo at PlugFi at Bitcoin Miami last year of doing an AMM, like kind of Uniswap style AMM using covenants, which was very cool.
Yeah, I'm a big fan of that. I'm a big fan of those. And yeah, we on Bitcoin Cash, I'm no longer working on Bitcoin Cash. Like they can do their own thing, but the historic origin is from Bitcoin Cash. So I actually started developing after I joined Bitcoin Cash. So I wasn't like very early. So I had Bitcoin on my peripheral and everything, and then I was like, oh no, this like the idea behind the big block side, like those ideas make more sense to me. And yeah, so there on Bitcoin Cash, they currently have something called AnyHedge, which is basically dividends, kind of like, so you can like lock up some BCH and then say, okay, whatever happens, I will get exactly this dollar amount, like this, like you basically stabilize your asset. And then another party is in there in the same UTXO, right? Like it's basically a UTXO that has like some smart functionality written in it. And then it executes like the contract at some point. It doesn't really execute a contract. Like you have to build a transaction that then spends, obviously,
like a DLC kind of thing, like discrete log contracts, which you're like specifying it to some kind of like dollar BCH exchange rate.
I think so. Yeah, I haven't heard of that yet, but it seems to be like the same thing. Yeah. But I think that's the interesting part behind that. So to address some of your points, so you said that Bitcoin as a base layer should provide stability? Do you mean stability in the sense of like just being robust, or do you mean stability in the sense of price stability, so that like, you know, it doesn't fluctuate too much?
I think it should. So like you don't want to guarantee price stability, obviously, right? Because then this is going to run into some kind of like external oracle information, like, you know, kind of problems. But I think that something that has stability at the protocol level and increasing demand, right, for actual usage will converge on price stability, right? Like the more and smaller transactions you have, the lower volatility you have, like basically like a, you know, higher market depth, you end up with like a smoother price function. And there's a virtuous feedback loop there. Whereas the price function gets smoother, people are more willing to take payment in it because like they know that, you know, the payment I'm taking now is what I can expect it to be tomorrow, and so on. And so you see more ordinary usage, and that's kind of the feedback loop that you want to incentivize.
So
you know,
with more usage comes more stability, basically.
Yeah. And with more stability, you know, comes more confidence and therefore more usage.
Okay. I used to think that. I'm not sure if that is true anymore, because like if you look at the oil price, for example, it also like has a lot of transactions going back and forth. And I don't really see that being very stable, because there's a lot of like environmental factors, just like in Bitcoin. There's a lot of like beliefs, there's a lot of politics in there. And for the time being, I'm not like, of course, this is like a little hard to tell, because it's like, what will this look like in 10, 20, 100 years? Right? Will it be stable in that time frame? And, you know, in 100 years, probably Bitcoin will be quite stable, like the price. But like in the short term, I think it will remain very volatile, such that using it, and, you know, that for any like limited asset. Yeah, what do you think about that?
Well, I mean, so the thing with oil, so there's like two things I would point to as impacting that. And like one is obviously that the supply is cartel based, and that cartel is like heavily geopoliticized, right? And so there's like a constant immediate interaction between like geopolitical events and the political events in those OPEC members, and like what we can expect like the supply and demand, you know, kind of to be. And then the other is like obviously energy futures markets are enormous. Where, I mean, right now, obviously there are significant Bitcoin derivatives markets, but not the way there are like energy derivatives markets. The other is that I could be wrong about this. Like I haven't really done like a regression analysis myself or whatever, but like Bitcoin has gotten less volatile over the last few years. Like obviously there are big like step changes, but like in between those step changes, you know, it goes long periods of time where it's, you know, fluctuating within a fairly small range, like right now, for example. Or previously like around 30 or around 60, where that was not really so much true 4 years ago, 3 or 4 years ago. And I suspect that a lot of that does have to do with market depth. So this is like, there's an empirical observation, not just a priori here.
Yeah, I also see that like there's been like in the early days of Bitcoin, it's been way more volatile. So I'm willing to think that yes, over time it will become more stable. I'm not sure how stable. Also, we have like these feedback loops, which I think might smooth out in the future. But if it's mostly a speculative asset, you know, we can get into that later. Then those are actually amplified. So, you know, the argument goes, if the price of Bitcoin goes down, then you know, like everybody in the space gets a little poorer. And then like people like they have to sell stuff, they have to fire people, everything happens, so the price goes down even more, right? Because there's no like mechanism to stabilize it. Meanwhile, all the number of coins that get emitted every 10 minutes stays exactly the same, right? Like right now it's 6.25 new coins every 10 minutes. So those coins have to go somewhere. Whereas with other like resources, supply and demand kind of match, right? Like if there's a like with gold, you can see that. Like right now we're dragging a like incredible amount of gold out of the earth. Like I don't think the production rate has been higher. Like it's enormous. Like the amount of the tons we pull out of the ground, and I think that dampens the price because the price went up Also, we got derivatives and everything, but we just know that for this resource, supply and demand will match. Whereas with Bitcoin, the supply is constant. Like it never will change. It will always be. It halves every 4 years, but like within that, it doesn't react ever to supply and demand.
The increasing the supply growth rate or new supply available. Yeah, but I mean, I think the rate of growth in gold production is like fairly like low and stable, right? I think it's something like it averages like 4% a year increase in production, like over the past, I want to say like 200 years or something like that, and has not like, because obviously, it's not like electricity production where you can just like, there's enormous amounts of energy to spin up more things. Like there are only so many like places where there are gold deposits and so on.
But of course, like it's always about the marginal price, right? So if the price goes down, then you only need a little bit to like, decrease supply a little bit and so forth. But yeah.
Mm-hmm. I was gonna say with regard to the speculative usage thing, like you're right. And I guess like to be more precise, what I mean by more usage, I mean like actual as opposed to speculative usage also.
Mm-hmm.
So it's like the ratio of speculative to commercial usage, right? Like the more speculative usage there is, like obviously the more vulnerability to these feedback loops between like perception and reality, basically. Whereas like, usage to actually like buy and sell goods and, transact in a first order economic way is much less vulnerable to that. And so, the more we shake speculation out of the system and the more we increase like actual usage for goods and services also, I think the more stable the price will be.
Because there's like a broken incentive, because speculators only make money when the price changes, right? Like if you just hold it and it stays exactly the same, you have huge opportunity cost because you're basically just holding a rock that doesn't do anything. If you just in for speculation, it has to go either up or down. And so it is very important to like remove or keep the amount of speculation to a healthy level such that it helps with the price or like with actual utility. So I'm totally on the same page there.
Yeah. I think this makes the number go up thing is really pernicious. And this was also what like the conversation in El Salvador, a lot of it was around like the supply cap and like whether deflationary incentives are bad or whatever. And I will say it was kind of a red pill to see like a room full of Bitcoiners refuse to like pay with sats for a meal in like the first Bitcoin legal tender country. That's very short-sighted, because it's just circulation and ordinary usage is what will cause like number to go up and hyper-Bitcoinization to happen, and if people aren't contributing to that. But again, this is a very first world sample, right? Like people in Nigeria and Venezuela and Turkey and Lebanon, actually are using Bitcoin, I think more so than people are here. But we'll see.
Yes. I also had the same realization. I mean, a few years ago already, which is why I like shifted my focus more to work on tokens, right? Especially stable coins, because Gresham's law, people want to get rid of their bad money and they want to hold their good money. And I'm no fan of the US dollar. I mean, compared to the euro, it went up. So yeah, number go up on the US dollar. But if we want to, there's multiple issues. Of course, the stability. Second of all, the NGU, and a third of all, the unit of account. Like this is very significant. People don't think in terms of sats. They don't think in terms of BTC. What's the price of Bitcoin? You say, I don't know, 20,000 US dollars. You don't say, what do you mean? Like it's one Bitcoin, right? Like nobody replies to the price of Bitcoin to be one Bitcoin. And everybody would be like, well, why are you telling me that? I want to know the price in US dollar. And like these units of accounts are incredibly sticky, The dollar, it comes from the German Thaler, which is a reference, which means just valley, and it's a reference to Joachimsthal, like a Joachim's Valley, which is like from 500, 600 years ago. And we have this lineage of different dollars, just like, the German Thaler, then the Spanish, I don't know the exact order, but the Spanish dollar, which then got used in the colonies in America, which was around way before the Constitution was written in there, and now we're here. Like that's one bloodline back all of these years. So I don't think that with Bitcoin we can just be like, okay, let's use, like for me it's very hard to imagine if like like the payment infrastructure in this area went down like a few weeks ago. I was like, okay, like why is there no solution there? And I heard in Canada there was also like crypto is supposed to solve this, and it's not there. And one very important thing is to imitate the feeling of fiat as much as possible while still being like normal.
Right, in terms of the UX, right? Like you can't beat cash. Like cash is the ideal UX for money.
It is, yeah. Which is why on the,
like, when,
go ahead, yeah.
What does that psychological flip over look like? Or, what is the threshold for it where we start denominating things in sats? And obviously like reduced volatility, increased like capture of economic activity is one of them. But it's interesting, like, where does that flip over happen? And then how does it affect, because like the way, deflation or inflation, any of it, drives behavior is through psychology, like how people, do they think about it as money or as an asset or whatever? And so if we do hit some sort of threshold where people start denominating things in sats and not thinking about like, what is the dollar price of sats, but I think as you say instead, like, what is the sat price of dollars? Like, does that fundamentally change what kind of incentives the money supply creates, right? Does deflation produce different incentives if it's deflation of something people think of as money versus something people kind of think of as money, or think of as an asset or whatever?
Yeah, and there are people who think that it will never be, or it will take a very long time, and big Bitcoin supporters who think it will always have to have some other bootstrapped thing. So I think what will happen is that we will start with stablecoins who are pegged to the US dollar, but that they might allow themselves to depeg. So it could be like, okay, this is a US dollar coin, but we're backed by gold or something, right? So in case something happens, you will always be able to redeem a certain amount, or like there's some contract behind that. And then people are able to use that or some other resource. Maybe eventually it will be a stable coin, but backed by sats, right? Backed by Bitcoin or some other cryptocurrency. And then you could be like, okay,
I think Bitcoin-backed CBDCs and stablecoins seems inevitable to me for UX as well, for like a lot of different UX reasons, including like price stability.
That's the first time I hear that. Why do you specifically say Bitcoin-backed CBDCs?
Well, because I think as the dollar, loses like attractiveness as a reserve currency, we're going to states are going to look for things to back their currencies with, right? And so like gold is an obvious first choice. Like the mixed basket of foreign currency reserves like still opens you up to a lot of the same kind of instability that you have if you continue using the dollar as a sole like FX reserve backing for your currency. And it seems energy is another option, but like Bitcoin seems like an obvious one. And so that's like, it's kind of a parallel evolutionary track, right? Like the incentives of states with regard to their own currencies. And so if some of them start choosing to use Bitcoin as what they back it with, right? Like that's basically just a mode for the mass issue of Bitcoin backed.
Why would they do that though?
Like same reason they'd use gold.
Well, but I think the reason there is for example, Russia recently started backing their coin, their token with gold. I think a part of that is because they're one of the largest producers of gold. And I don't really maybe China will start to be that, okay, we got to back it. We got the most miners or something. But it's an interesting take. I'll have to think more about that. So let's go a little bit into the CBDCs area, because for me for me personally, that's a big enemy. Like I view CBDCs as a very bad development in which will be civilization changing, just as Bitcoin is civilization changing. It's kind of inevitable in my view. Like you have the internet, and therefore CBDC is kind of like a logical conclusion. What do you think about CBDCs? Have you maybe you have a different view, and maybe there's some.
No, I agree with like both of those main points. Like one, that it's inevitable, and two, that it's a bad thing. Like it is the enemy that we're going to have to fight, right? I mean, it makes sense. It makes it much easier for them to track the usage of money, survey it, to like mass, rebase accounts, or like, engage in inflation rather than through manipulating interest rates, through actually like, minting and airdropping CBDCs to people, that kind of thing. So like monetary manipulation and like surveillance of money users is obviously in the interest of geopolitical actors. And it's the path that they're going to take. Including in the current time of instability in currencies, like making money manipulation easier and faster is going to let them take back control, or at least hope they can take back control of some of their monetary dynamics. And so obviously all of that is bad because it lets them control and track and freeze everybody's money. It's taking advantage of whether they use like actual blockchains or not. I'm sure it'll probably look more like a proof of authority chain kind of thing in most cases.
Oh, we actually know how it's going to look like. Have you looked at Project Hamilton?
No.
Oh, it's it's a very, very interesting project done by the Boston Fed, the Federal Reserve in Boston, and in collaboration with the MIT Media Labs Digital Currency Initiative. Did you find it?
Yeah.
Yeah, it's like they have a big white paper. I think you should be technical enough to read it. It's like if you're a software developer who worked in Bitcoin, they use exactly. I mean, sometimes they use different words, but they kind of use our language. I highly recommend you read that. I can also send you a video that Amory and I did, where we kind of give a high level overview, disassemble the project a little. And there, I think what is fascinating is that they are not a blockchain. So they are just a centralized server that uses a centralized consensus algorithm. That, it's fallback.
Like an ACID database, yeah.
Yes. But, and here's the interesting thing. They use UTXOs. They use a UTXO set for the storage of US dollars, right? So they have 64-bit ints. So the maximum number we can ever have is 18 trillion US dollars, I guess. But yeah, they use the same transaction structure as Bitcoin, except for some tweaks, right? Like some fixes, transaction malleability is one, including the spent output in there is also one. So, and this kind of leads us to the eCash question, because what they're able to achieve, if you look in there, or I think on page 24 is a graph with the transaction throughput. I'm not sure if it's exactly on page 24. They show that with 32 instances of AWS, I don't know which exactly, some C whatever, they are able to process 1.7 million transactions per second. 1.7 million transactions per second, which of course is insane. If you compare that to Bitcoin, how many transactions per Bitcoin can Bitcoin do? Without Lightning, on chain.
Transaction is what, like 50 V-bytes or something like that. So
it's around, if you do the math and you of course it always depends on how big the transaction is. Turns out to be 7 transactions per second. So here we got a few orders of magnitude in between. It's around 20,000.
But that's L1, right? Like Lightning can support a lot more than that. And not arbitrarily scalable, because it's a question of
can it? Well, the question is, can it? So we got multiple question marks there, and I don't think they're solved yet on Lightning. First of all, we got the liquidity issue. You have to lock up a lot of money into the system to do swaps. And second of all, you have the centralization pressure, it's the most efficient outcome of Lightning is to have just a few nodes having all the liquidity. And then, like, we see that happening. 50% of all the liquidity on Lightning is just in 5 nodes. When I set up my phone, I don't know which route I'm taking. It's just like a few handful of nodes. And then we're like, okay, like, you know, the Federal Reserve has more than 5 nodes. Like, why are we using a system that is so centralized?
I think at a certain point, this becomes like an intrinsic feature of the networks that we're talking, like hierarchization of a network to like specialize high throughput nodes or like hub nodes versus edge nodes is going to reemerge at some level, like whenever you scale, right? If you want to scale in a way that is like economically efficient. So like, I mean, with like big block solutions, for example, like, you know, you do get centralization, in like validation of the chain, right? You can have fewer node operators. And like some version of that is always going to happen because it's just like a, you know, a completely flat gossamer mesh network is never going to be efficient. And that's why we don't see it in the natural world, right? Like everything follows like power laws of scaling. That stratifies things into specialized hierarchical levels.
But then the question is, like, if we no, go ahead, finish. Yeah.
Well, just like, does the centralization prevent people from, in a fairly efficient way, doing like peer-to-peer like edge connections? And does usage of a relatively centralized operator imply trustfulness, right? Like in different, obviously there's more than one dimension of trustfulness.
So I think the contrast is, how does a, you know, semi-centralized Lightning network look like? How can censorship, how is permissionlessness there? And how is a semi-centralized, how would a semi-centralized big block solution look like? And also, what are the incentives on each? Towards what does each of them like converge? And I think with Lightning, it's very clear. Like with Lightning, the most optimal solution is just to have like a central bank. With because, you know, if you have all the liquidity there, you only have to lock up what you need. You don't need to have multiple channels. You know, it's all just like one kind of network. With big blocks, I'm not so sure if first of all, this centralization pressure that is so prevalent, because you know, you need all you need is more computational resources, but you don't need liquidity. You don't need more liquidity to process and to like be a big node that can process a lot of transactions on the network. So then it's purely a okay, how can we optimize the throughput of this system? And what we see there in that paper, in order to process 1 million transactions per second, which, by the way, is way too much. Like, that's way too much. That's way too fast.
Even American Express does like 10,000 a second or something, which means that maybe all of the major credit card operators together maybe do a million.
Yes. So we need way less than that. And I think if they have one instance of AWS, it's like 100,000 transactions per second. So here we have a system that is able to, you know, basically they have like a multi-phase commitment kind of system, which I think is very genius. You have such a system which looks very much like Bitcoin, and you know, we can get into who actually built that in a little bit. It looks very much like Bitcoin. It can handle a lot of transactions. All you need is like roughly like a few AWS instances. So I don't really see. We have to prove, in my view, right there, that we can like at least 10,000x the throughput on layer 1 without sacrificing a lot of like what you would call decentralization, or like having a lot of nodes basically on the network. Also, what you also have to keep in mind, what I think is a way more important question is economically viable nodes. So if you have like a big exchange running like 10 nodes, those will always be way more important than some guy who just likes Bitcoin and has it running on his Raspberry Pi or whatever. If we have a lot of money ensuring, like if there's like, okay, we need to have these nodes running, like, okay, we can spend like, I don't know, $1,000, $5,000 per month on these nodes. And by the way, 5,000 to 10,000 for a business, that's nothing, right? Those are like very low expenses. And I think then it only then I think the only question really is, do we want a Bitcoin that is run mostly by businesses, or do we want a Bitcoin that's mostly run by, you know, hobbyists and people who are able to like run it on their laptop and so forth?
Yeah, I mean, I think we want it run, you know, the ideal is that we have it run by businesses, but not solely businesses whose business is to run the network, right? Like businesses that do other things and have a node, you know, that in the economy, and have a node that lets them do that, so that, you know, like your biomedical company or your corner store or your hardware business, whatever, like is simultaneously a blockchain entity. I think that's like the ideal world to go after.
To some extent, but you know, there's no solutions, only trade-offs. But yeah, I agree that ideally you have like all sorts of nodes doing that. And you know, to some extent we can probably do sharding, where it's like, okay, like if like we need resilience, if we want, okay, you know, you need to be able to process, like you should be able to use your own transactions. And you know, that's where it kind of gets like religious again. It's like, okay, you should run a node. Like you shouldn't do it from your own economic interest. It's just because you want to support the project. But you know, we could probably do something like sharding, or like you process like a subset of the blockchain and so forth.
Yeah, but I mean, you know, obviously Ethereum has been trying to make sharding work for 7 years now, something like that. You know, and like Dfinity claims to have made it work, like things like that, but it's obviously enormously difficult and like security wise, largely basically untested or unproved in the wild.
Well, on Ethereum.
And again, like I'm not really buying into the preferability of this over L2, or like the necessity of like total centralization in Lightning. Because I mean, there's a question of like, you know, how much money are you making off of running something, right? So like obviously there's a tendency to create hubs because like you can make a lot of money off of being a hub, right, in Lightning. And it's good for the network to have hubs available for high throughput, right? But like if there's a certain number of, you know, expenses that I have that I want to transact over Lightning, it's basically just as easy for me to put like a little bit of liquidity that I need into some channels that are like, you know, directly with certain networks of producers that I interact with, or like, you know, a friend who has a gateway, you know, to a hub or something like that, right? And the thing is, like, crucially, there's no difficulty posed for me in doing that, right? The existence of hubs in no way stops me.
Oh, I absolutely want that.
On the other hand, having a giant blockchain does stop me from running a node, right? An L1 node. So like, you know, I mean, having like, you know, terabyte blocks or something like that does absolutely make it impossible for the ordinary person, or the ordinary small business for that matter, to run a node on L1. But there is no such dependency in terms of L2. You can have both big and small in the L2 solution. You can't have big and small when you're talking about big blocks. So that you know, availability for people to specialize in different directions according to their preference, I think, is important. And like sharding, it, you know, at this point, it still seems to me that like sharding is a little bit of a hand wavy response to that, because we just haven't really seen it work, and it's incredibly difficult.
Yeah. So just to finish the point on sharding, so yeah, I agree. There are ways how you can do it. They're not very tested, and I don't think it's necessary, because like we know how scalable where we can be. On Ethereum, scaling Ethereum is exceptionally difficult, and and this is also why Project Hamilton, like this is why the Federal Reserve went for the UTXO model that Bitcoin has, because it turns out that the UTXO model of Bitcoin is actually highly scalable. So yes, we have like one shared state that everybody shares, you know, where everybody updates the same system all the time. However, updating this can be highly parallelized, right? Like we can update the database. First of all, we can like have multiple instances collaborating. Like you can, like we would call that also sharding, but it's a different sharding. It's like just distributing across multiple machines.
Regular database sharding.
Yeah, exactly. Like a multi-instancing probably would be more precise. I don't know. So you run the blockchain on your own servers on multiple instances, and what you can do through like the UTXO system, and that is in the Bitcoin Hamilton, the Project Hamilton paper. They do like a two-phase commitment where like you get all the inputs, you collect all the outputs, and then you like distribute them according to like which shard they spend or which shard they create the UTXO on. That's basically the way it works, and that way you can like flood out and go back very quickly. Also, what they did is like they made sure that a transaction can be like isolated in vacuum, except for the like if the checking if the UTXOs are still exist. So you can like verify the signatures without having to do a database lookup. You can just like look at it in isolation, and there you can also see how this can be highly parallelized, right? Because you don't have you have like just check if the transaction is valid, and then check if like it spends something that it can't because it's gone.
Right. But to be clear, this is like an AWS cluster that's doing all of this checking, right? Like they don't have any kind of like distributed verification. Like it's fully centralized, right?
Oh yeah, absolutely. It's just one server. It's just one server. Yeah. However, we can do the same thing on Bitcoin, right? Like this is basically what they're doing is basically building a mempool, right? So we on Bitcoin Cash, like where initially I wasn't a fan of that, but they did some testing, like how much can this blockchain actually handle without like getting troubles. And they were flooding the blockchain basically. I didn't like it, but what we saw is that 20 megabyte blocks were quite easily handled by the system, and the big problem was not like block transmission, but mempool acceptance. So like there it choked because it's sequential, right? Like you get a transaction, you have to verify that it goes in. With this system, with Bitcoin basically, or like the UTXO system, you can actually highly parallelize that. So you can run this across like 24 cores or something, like.
You have a problem with like inefficient block production there, where like if you have like with a really flooded mempool, right, that like different block producers will like create different blocks and will end up like wasting their work. It seems like we'll like draw different subsets of the mempool, like a very high rate of wasted block production. Yeah.
Oh, I see what you mean. Yeah. I don't. Well, there's multiple answers to that, and this also ties a little bit into like the Avalanche thing, which I think you were very curious about. So we got this. Well, first of all, the mempools don't have to diverge that much because you send a transaction and then it gets flooded out, and then people sort of have the same mempool. Also, like miners, they have kind of an incentive to keep the to keep the same transactions in the block as everybody else, because then it takes way longer to like synchronize on a network. Also, if you like what we did on eCash, we order all the transactions by transaction ID in the block. So this is already in there. Bitcoin currently sorts it by like, topological basically. So like whatever came first has to come first. This is actually like at scale, the order information is actually very expensive. So we removed that by just enforcing canonical transaction ordering. So it's just locate transaction, just sort by transaction ID. And then you can transmit, like if two miners have very similar mempools, you can transmit blocks very cheaply because you just have to like do set difference. You could just be like, okay, what do you have in there? What do you have in there? And then I don't really see a big waste in there.
Okay, that makes sense. And this prevents, which I guess like you wouldn't need if you have like giant blocks, but like you can't do like RBF, right? If you have this like,
I'm not a big fan of replace by fee because it like severely limits the usability. I'm like, it should be finalized within a few seconds, because otherwise you can't really use it in commerce. Like I used Bitcoin on chain. I used Bitcoin on chain in Mexico on like a bar that said Bitcoin accepted. It was all replaced by fee, but it's basically like, okay, if you replace this, I'm not gonna, like, it's time for you to leave, right? So it was like socially, like we could just as well have kept the tap instead of using Bitcoin. But for everything that's more professional.
Anything that like is MEV like, I don't know how familiar with MEV, minor extractable value, like MEV protocol, like with Ethereum, and just like the really pathological dynamics that you see terrible, there, right? With like, you know, sandwiching transactions and like sniping transactions and things as just like an accepted way that blocks get structured. It's just incredibly
how do they call it? Dark forests, right? Like somebody found like an exploit in a transaction, and then they sent it on the network, like they exploited a contract basically, but they did it incorrectly. But still, some bot or whatever discovered the transaction, was like, oh, wait a second, somebody's extracting value from there. Let me do the same transaction but correctly. I don't know how it exactly worked, but it's like these crazy stories that happen on Ethereum. And I'm not a fan of Ethereum, also due to the scalability. It's a point that I can also finish later maybe. And what we need is something that like comes to consensus very quickly and then stays there without like where you can reorder stuff, change the past, and so forth.
Right.
But yeah, and that gets into Avalanche that we're doing on eCash. But let me get back to the to why Ethereum is not scalable, and that is because the outcome of a transaction is order dependent. Like if you execute transaction A first and it like withdraws Ethereum to another account, and then you execute transaction B and it also like withdraws the same amount to a different address, then and you only have like a certain amount, like only one of them can be valid. It's not clear which one will be included, which one will be executed first. And that means, and here it comes. On Bitcoin, we can collect transactions in the mempool, and then and validate them. Like they're like, okay, signatures check out, like time lock, everything is fine. Then when a block comes and we see all of these transactions in there, we don't have to verify the transactions again because they're valid already, right? The only thing that can happen is that there's a double spend in there. But a double spend is very different from checking signatures. You just do set check, you do set reconciliation.
Right.
On Ethereum, however, you get a block. You have to execute every single transaction in there. You can't just be like, oh, I saw this transaction there, it's probably valid. No, because it could be invalid because some other thing spent the precondition or something. Does that make sense?
Yeah, of course. I mean, and like this is
go ahead.
Anything that's Turing complete is going to have this problem. And indeed, like anything, I mean, if you look at like Taro, for example, I don't know if you're like this like Taproot asset representation overlay that Laolu proposed this spring. That's like, basically it's a way to do tokens using Taproot where like, tokens, whether it's like fungible or non-fungible, are encoded as like a subset of a Taproot tree. And it has like a proof over it. He invented something called sparse Merkle sum tree. So it's a tree that also encodes like what the total value of all of the nodes in it is. And it's sparse, which means that you can do cheap proofs of non-inclusion. And so you can show that there are not like double spends of the asset that's encoded in this Taproot tree, which has been tweaked into the Schnorr signature on the UTXO on layer 1. Anything like that, right? Where you have,
I think I understood 60% of that.
Yeah, Taproot is like it's a whole own rabbit hole. But yeah, I mean, basically anything where like multiple people can spend from the same condition is going to have like ordering issues, right? Because you can have multiple valid spends in the same mempool. So like avoiding that is like always going to set a limit on your functionality to some extent. And I don't think that you necessarily have to completely avoid that, but it's just like tendentially we need to avoid like introducing those kinds of dynamics into block production.
I agree. And but just the general idea is like if you like there's still a difference, because if you have multiple spenders, like multiple possible spenders in a UTXO, like multisig and like 1 out of 3 multisig or something, then they construct a transaction and like one of them constructs a transaction and spends the UTXO, then broadcasts it over the network. And then if a block mines that transaction, all the other nodes, they don't have to check the signature again. They don't have to check anything really. They just have to check if like there's no conflicting transaction, which is very simple, right? Whereas on Ethereum,
Right.
if you have that transaction in your mempool and multi-sig or whatever, you have to check it again, because I mean, maybe you can cache the signature or something, but you have to like query and check if the account still has a certain amount of balance, because before it could like spend too much money.
So the account, yeah, gotcha.
Yeah, and what that implies is that Ethereum block validation is inherently sequential. Like you could maybe do like a DAC or something, right? Like a graph where like, okay, let's factor it out or something. But imagine the complexity of that. Like how would you even like figure out the dependence? That's probably like something complete.
Yeah.
And
I've read a lot of like blog posts that I understood like 60% of that were trying to do that, to use DAX for this.
Yeah.
I have a friend who thinks it's possible, but he hasn't convinced me yet.
Yeah, I'm not convinced either. And so for the time being, I believe that Ethereum is sequential. Like you have block validation is sequential, and because you have to figure out these dependencies. Maybe you can like optimize it somehow, that you're like, okay, let's like you do some assumption. Okay, assume we have enough balance, then what? But still, like, what if like you have this global state, it updates and so forth, and it's just very, very unscalable. And therefore, by implication, sharding will also be incredibly difficult, because how do you like shard a global state? Like, by definition, It's sequential. So basically what I think Ethereum is now doing is they kind of have just multiple blockchains, which are like woven together. Like if they shard it into 1,000, then it's basically just separate blockchains where you can like atomically transfer between them, more or less. And
yeah, that definitely seems where it's going. Yeah.
And
it's a experience, and it's not robust. Like,
it's terrible.
I have a bet going that ETH2 is going to last like 12 months before like a DAO level incident, like something goes really bad.
I mean, that's optimistic.
Yeah, I know.
But they have to build the stuff first, so maybe it's not too like, because it takes a while to probably build something that's. But yeah, because you have these dependency issues, it's like, okay, and maybe they could like, we had in DAO, we had the timing attack kind of, like you had like an ordering thing, and then this happened first, and then it didn't like do the other thing in time or something. And with this, you just like square that problem, because now you have like intra-chain ordering, and you have inter-chain ordering, intra-chain ordering. You have like two dimensions that you're operating in, and it just increases the complexity even more. Then it's like, it's already way more complex than Bitcoin. And I think that's the beauty where we probably both agree on. Like the beauty of Bitcoin is the simple UTXO model that we can use. So yeah, I think we converge. We're on the same page there. What do you think about like if we were to raise the block size to like, I don't know, 32 megabytes on Bitcoin? Do you what would like, do you think there's anything that would stand against that? Like, because that's more conservative. It's not like 1 terabyte or something.
I mean, I think right now, I just don't see any need to do. I mean, I think in the future, right? Like, so Lightning gets us a certain amount of scaling, right? Like, say it gets us to like 2 billion users or something like that. Okay, so that's still only a fraction of the world population. So maybe in like 20 years, we need to like raise the block limit to like, 5 or 10 or maybe even 32 megabytes or something, right? But like your principal, this is like to accommodate like a principal source of scaling, which is somewhere else. Right. So the question is like, if we raised it like right now, would we see like the equivalent amount? Do we have the demand that we need to justify raising it right now? Because it would certainly make it, even a 32 megabyte block would make it significantly more difficult to run a node. Like it's already, reasonably expensive to run a full node, like on a VPS or something. I think I pay.
Yeah, I'm running one, and it's the most difficult after Ethereum, the most difficult to run node. It's the most difficult Bitcoin node to run after maybe Bitcoin SV, but let's just pretend those exist. Those don't exist.
They're not real. They're just not even worth it. Yeah. So like it's already fairly difficult. It would make it significantly more difficult. It would raise it to like, small business expense kind of level. And it's like the only reason to me to do that is if there is enough demand that we need that would fill that kind of scaling right now. And the way I benchmark that is like how much lightning activity with 32 megabytes gets.
Okay.
Right. And I don't see there being like even like the rate of growth of use of lightning has been big, but not big enough to use 32 megabyte layer 1 block worth of lightning transactions right now.
The original lightning paper, I think Joseph Poon, something with Poon, like the paper that introduced that as like a scaling solution, and some other authors, they actually quantified that, or they tried to quantify that. And what is interesting there is that for global usage and lightning, even Bitcoin Cash is not sufficient. Like the block size in their estimation is still too small. So for like billions of users, if you have lightning, and of course that's always like a rough estimate, they say you need like at least 130 megabyte blocks in order to facilitate lightning on a global scale. So I don't think lightning will get us like far like in terms of global adoption to like get global usage, because we need to raise the block size to like by 2 orders of magnitude or something, maybe even 3. And then I'm like, why don't make the transition more painless, right? Like let's raise it to like 2 megabytes, 4 megabytes, 8 megabytes, and we can like do it in like multiple steps, because we need to go to 100 anyway.
Because if we do a large block size raise right now, that means that like all growth that occurs after that occurs basically without growth in the number of validating nodes, right? Or that all the 0% of those new users thereby supported are running their own nodes. Whereas like if we increase it in increments, like only as needed, which is along the same lines that like the cost of storage goes down, the cost of processing goes down, availability of people to run their own servers increases, stuff like that. That means that like some of this new uptake of use will be fulfilled by ordinary people running their own nodes, right? Like that's the difference. Like if we raise it hugely right now, we're abandoning like any desire for more people to run nodes, and for it not to be a completely professionalized or commercialized service, right? All of these people will be using light wallets. So
yeah. Oh, do you see anything wrong with? Do you see anything wrong with using light wallets? Because I'm.
Yeah, I mean, we don't have fraud proofs, which means they can be Eclipse attacked. Like, I think there's good reason, and especially like
an Eclipse attack is like where you fake a block header. I never heard that term, but is it where you fake like a block header for an SPV?
Like I eclipse your view of the network with malicious nodes of my own, right? So like you're an SPV wallet, right? That means you depend for your block headers on some subset of nodes, of full nodes in the network. If I can ring you off from the non-malicious nodes by getting you to communicate only with my malicious ones, then you've been eclipsed by me.
But you need to be a miner for that.
Huh?
But you need to be a miner for that, right?
No, you can just do it with malicious full nodes, I think.
No.
Well, no, no, you're right.
You need to be a miner.
Yeah, you need to be a miner, but you don't need like, a fixed percentage, of the hash power or anything like that.
Why not? Because you need to be able to produce valid blocks. Right?
Yes, but like you don't need to.
It's basically 51% attack.
You're just trying to convince a particular light client.
Yeah.
Right. That like something has changed. Right. So you don't need to like convince the entire network by having, a cooperating.
One block, but first of all, they will probably receive the other blocks. Like it's very hard to prevent a light node from receiving block headers. And then you kind of have to 51% attack that node, right? So it's basically a 51% attack, which costs millions of dollars.
Well, you have to 51% like attack like their connection to the network, right? But not like the network's production of blocks.
No,
right?
just that one node. Yeah, you have to 51% attack that one node.
Yeah, but they're connections, right? So it's a Sybil attack, and like Sybil attacks are cheap. That's why they're so common.
Yeah,
right?
But you still have to produce.
Whereas, like, obviously, a 51% attack, like at the consensus level, is super expensive. But you can run one miner and then Sybil attack the gossip network, right? Like full nodes, or like you're not Sybil attacking the whole network. You're Sybil attacking one light client's view of that network, right? Like this can be pulled off. And if you're reasonably motivated, you could do it. Especially, and this becomes a problem if there are a whole population of light clients that are relying on a relatively small number of connections, which is probably where we would end up. And it's more likely to happen the more professionalized and small a subset of the network, a subset of the user base, full node operators are. Right?
Yeah, I see that.
Nigeria has a handful of full node operators, and there are like millions of light wallets that depend on those. Then like the potential gains for executing an Eclipse attack against those light clients is potentially huge, enough to justify the social engineering and malware, like whatever you would have to do in order to pull that off.
It just seems like a block header is 80 bytes in size. So if that were to be a threat, I think that there would very quickly come a solution in order to transmit as many, like, is it okay, give me as many block headers as you can. And there will probably be, and maybe there will be like a service provider who's like, okay, I will make sure you have the full view of all block headers in the system, and you pay them like an insurance, right? Then you don't have this Eclipse attack because you have like a few, and maybe you have a few of those services. Then, and maybe you have a very high value. Like if that is really an issue for you, then this seems like a very, very simple problem, because you basically have like, you have like one floppy disk of data per year that you have to like communicate to a certain node.
Right, but if in practice, as you say, people like the easiest path solution to this, right, is a centralization, right? Trusted centralization. We have like some particular operators that are like, these are the guys that we get our block headers from, and they promise that they'll always give it to us. Well, we see companies like that in the current Web 2 world getting hacked and suborned in various ways all the time. Like at sort of the outset of Bitcoin, we've decided that kind of solution is not an adequate solution, right? At least not at the level, not a fundamental level of like, global monetarity, right? Maybe it's fine. It's fine for some things like circle of trust kind of stuff, but like not for that. We're trying to be more robust than that. And then the other side of it is also like, and this is, it's less of a, I guess a technical security necessity, but I think it's worth weighing that people should be able to like verify their own transactions, right?
Yeah,
and
but
like,
that's again more for like a, okay, this is like what's the reason behind it, and then we could get into that. And people can verify their own transactions, they just can't verify that there has been like a like they don't have a full view of the network to check if there's like a double spend somewhere on the network. But they're able to check the signatures, they're very able to verify these other things. Yeah.
So in a sense that goes all the way down to the soundness of the money that they're transacting.
Yeah, exactly. And I think for me it's a trade-off. So it seems like many Bitcoiners are like, no, like we have to be secure, full stop. For me, it's like we have to be secure and useful. And if I have a Bitcoin network, and now Bitcoin is kind of fine, right? I pay like, I don't know, 50 cents to $5 per transaction, which is way more expensive than the other payment methods I have. But in like
to get a Lightning transaction costs like a cent.
Yeah, but I have to set up a Lightning transaction for that. Like I have to set up a Lightning node. Maybe I have to set up a node, or I trust someone else's node, and then it's like, okay, why did we do all of that if I'm just using a like node from someone else? And we don't know, like if this centralizes heavily, then and it requires a ton of liquidity to do that. Right now, I think that like running a Lightning node is super unprofitable compared to like the opportunity cost of having all of those coins in there. I read an article a while ago where like someone did like a ton of locked up a ton of on the Lightning network just to see how much they made, and it's like very, very small. So I think if once it centralizes, I think those fees will become like higher, and like it seems almost inevitable that those will become higher again. And if we have a big block,
definitely go up. I mean, for sure, like they need to go up.
Yeah.
Right. Like a cent.
Otherwise, it's not sustainable. All of that opportunity cost. Yeah.
Right. But I don't think it'll go. I mean, it doesn't need to go up to $5. Right. And like, again, and I think, you don't need to be a hub in order to make money that way. And as it is, like, I don't know. I'm in some Telegram channels, big ones of like Lightning node operators, and like, you need to put in some work to optimize, but you can make reasonable money. It's just like, you can't just do it naively, I guess is what I'd say. Is my impression.
And that, in my view, it creates another like centralization pressure. Like if only people who are like highly like specialized, who have the capital to lock up all of these coins, who have the like expendable liquidity, then it will just be a small group of people. And then like the question is, how is this different from the current banking system, where like banks like have these payment channels between each other, and you just have all of these intermediaries, whereas with Bitcoin you can send money from person to person like directly by just broadcasting a transaction on the network.
Well, but you can still do this with Lightning as well. That is a huge difference, right? Is like, you don't need a huge amount of liquidity to use Lightning at all. It just,
I don't think that's true. If you do the math, and I have to, like, my good friend Amory, he said in order to $100, like on a large network, in order to do $100 transactions, you need in the whole system locked up like billions of dollars just for these small value payments. So I don't think it's true at all that you don't need a lot of liquidity.
I don't need to see that analysis. I'm not even sure what that means, to do $100, like to do like a certain rate of $100 payments, or like per second.
No, just so that every node has a path where you can do one $100 transaction, right? I can give you the source on that.
Okay. I'd be curious.
I have to look at that.
I do love this.
But it kind of makes sense, right? Like if you have like a lot of hops, then each of those hops has to have $100 in there. And if
except
right?
About
no, like that's all. No, if you have one path and it has multiple hops.
But you know about like multi-path?
Oh yeah, payments? you could do like you do multiple hops.
Yeah, amps. You can split $100 payment into 10 different payment paths, none of which succeed unless all of them succeed.
Yeah, but what if all the other people also want to do that? They have to use the same paths, right? So in total, the every hop has to sum up, like you just have multiple paths, but each path, like it has multiple hops. But you just right,
but so the majority of Bitcoin needs to be like locked up, like needs to be in payment channels in order for payment channels to be used, right? But the whole thesis here, right, is that the way we use Bitcoin at all is by putting Bitcoin on layer 2, right?
Yeah.
And that layer 1,
yeah.
So it's not like locking up implies, right, that like there's an opportunity cost. Right, like there's no opportunity cost on L1 because there's no source of yield on L1, right? Like it doesn't cost me anything. The only thing it costs me to like lock up liquidity on L2 is the L1 transaction costs to enter the channel and to exit the channel, right? And then in fact on layer 2 I can earn yield where I can't earn yield on layer 1, right? So like it's not clear to me, like the locking up sounds worse than it is, right? Like locking up in a financial economy means something. It's like, this is why staking is so prevalent on Ethereum and things like that.
Yeah.
Right. But you're not like foregoing
I'm not a fan of that.
Yeah. You're not foregoing anything by putting your money in a Lightning channel, except to the extent that like from a UX perspective, like there's flexibility issues where it gets like all one-sided, and then it's like, shit, well, like I can't make payments with that money. But there are now at this point like 14 different solutions to the unbalanced channels problem. Splice in, splice out, loop payments, submarine swaps, like channel rentals, dual funded channels. I mean, it's a well-known issue that there are a lot of solutions to, but you're not foregoing yield or usability by having your Bitcoin in a payment channel. So like, I mean, who cares if like if 80% of the Bitcoin supply is in Lightning channels, because like it's actually being used, it's earning yield by facilitating everyday payments. And then 20%
but here's the big question. So obviously I don't know what the submarine swap or however that means works, but it just seems like, for me, like as an engineer, it seems like incredibly complicated. Why do we need all of these parts? Like where isn't this about anti-fragility? Like why do we have to have all kinds of systems that all like we need watchtowers and we need all of these things. Then we need to have liquidity providers. Those will have yield again and so forth. Like wouldn't it, like the Bitcoin system is incredibly, Satoshi said the system is robust in its unstructured simplicity and so forth. Why like for me it's just much simpler to just scale layer one. Like the amount of complexity you have on there, just make those transactions very efficient. We know how much it costs. Like the Federal Reserve made the calculation for us, right? Like we can just use that.
Simplicity in there are two different like functional appeals to simplicity here. So like there's simplicity that keeps like the nature and the value of the thing consistent over time, right? And makes it like robust and secure. And there's simplicity that uses centralization and professionalization as a shortcut to avoid like the complexity that comes with a self-sustaining living system, right? And I would say like the first one is valid. The second one takes us back in the direction of banks, right? Like, and this is like BSV, right? Where they're like, yeah, great, we have a mining cartel, right? And like they're also the full node operators. And so it's like at the end of the day, there's a small industry of people who like who produce the blocks, who validate the blocks, right? And they're providing the money service to everybody else. Okay, that's just a central bank, right? So now the central bank is like an oligarchy with like some fancy database technology under it. Oh, yeah, great.
Bitcoin is permissionless. Bitcoin, you need to be able, like I will consider Bitcoin where anybody can join at any time, which is why I don't consider proof of stake permissionless, because you have to have the stake in order to join. Same with
somebody
BSV.
Has to sell you the coins. Stake.
Yeah, exactly. Yeah, and you can just squeeze them. Like basically proof of stake, and I don't want to get too much into that, but I think it's a nice contrast from like the different ways we can approach Bitcoin. Basically, proof of stake is no different from our existing financial system, because our current system is proof of stake, right? You have to have a certain amount of money, you have to have billions and billions of dollars in order to participate, to have a bank and so forth. And you have to have that locked up, kind of like, I like to use the term locked up just because like there might be like a bad connotation to that, but I consider staking locking up. I consider
and it is. I mean, I think it's exactly valid in this case, especially since, at least for somewhat contingent reason, that like proof of stake and DeFi, like Turing complete chains and so on, go together. Is that like, yeah, you are foregoing yield, like you're committing to something in particular. Yeah, I mean, I think proof of stake is absolutely, it is automated fiat or like rationalized fiat. Yeah,
and it will converge towards what we have right now, because it's the same thing. Like it just looks different. Like it is more fancy, it has different things. So like
and just going back slightly to the CBDC is the enemy thing, just like a slight, I don't know, tweak on that, is like the sad thing is I think it's going to work. Like
no, it's going to absolutely work. It's going to be the most efficient system ever.
Ethereum is the new fiat, and it's going to survive because of that. There's like so much money in it that even when they they will just roll back the chain, like when ETH2 has problems, and they'll just keep iterating, and it won't fail because there's demand from institutional actors for a fiat-like system that runs in this regulatory arbitrage kind of context. And they'll do their version of layer 2, which is basically just like commercial banks under the central bank, right?
Let me tell you this. So I was at a meetup recently, and I met a guy who is like working for a DEX, and they said, "Oh, we recently got our banking license," and I was like, "What?" Like there's some kind of swap system and so forth. And I'm like, "Well, why? Like, isn't this like like?" And yeah, I 100% agree. Ethereum is just institutional.
Just want to make money off of the arbitrage, right?
Yeah.
In the technological transition, which some of them I don't hate
and
for
smart
that,
contracts.
and I do hate for it.
I don't know how much you are aware with. Did you read the FinCEN? FinCEN, FinCEN, the guidance. Yeah, the guidelines. Did you read those?
Some of it, yeah.
Yeah. Like I mean, me too. Like, but like ATMs are money transmission, and like giving money in person in exchange for crypto, like cash versus crypto, also money transmission. And very curiously, a smart contract on Ethereum, I mean, they don't reference Ethereum, but they basically say it in lawyer terms, is the money transmission, like a smart contract, money transmission. So that is like, I think that'll break Ethereum over the long term. It'll just be institutional finance, just, you know, using
right, because the stakers and the big DeFi DAOs that run things, the stable, like it's even true, like right now, for example, like if Ethereum hard forks, who decides like which of the forks is real? Circle.
Yeah.
Circle decides, right? Because they'll say this USDC is redeemable, Circle.
Oh, Circle, yeah.
Circle decides. Of course they do, right? Because that's where the money is. They'll say which one they're willing to redeem for. And like those people can be leaned on. And like ultimately they'll be leaned on to censor transactions, and it'll just be like one more state-sponsored ecosystem. It'll just have organically evolved.
It's Circle, like what's USDC is just a less efficient CDBC. I mean, that you can that you can use in Sushi Swap, basically. That's the end. But and let's talk a little bit about that. So what do you think, how will they roll out the CBDC? Why would because I tell people about that and they're like, why would anyone use this? So what do you think? Why would anyone use the CDBC?
Stimmy in the US, COVID bucks, that kind of thing. Or like in Germany to, you know, pay for your, you know, natural gas or electricity. It'll be something like that. It'll be paired with like upheaval, right? That's how they'll insert it. Like this is how you access the support system when everything is falling apart. Guaranteed, that's how that'll happen.
Yeah, exactly. It's gonna be UBI, COVID bucks. Also, maybe what I'm looking forward is reparations in the US, right? It's like, oh, here's your monopoly money. You worked hard for this. Your ancestors died for this. And right. And then you have like, then we're back to where we came from, where the US apparently came from, regarding slavery. Yeah. And I mean, we agree on that. I don't see why we should talk more about that, but it's like the scary part. Like it just seems so self-evident that it's going to happen. It's going to be very efficient. It's going to work. They're already making current systems more unreliable. Also, we have this tendency that like people just like, they don't understand money at all anymore. And, you know, like if they don't know how it works, like why would they want to look at the, like, why would they maintain the like payment infrastructure? So yeah, I think this is very, very important. And I think it's very, very timely. Like, would you agree that like we have to get a solution, and we have to get a solution quick? Do you think that Lightning right now is like, let's say the CDBC rolls out next year. Do you think Lightning right now is like a viable alternative?
Is capable of competing? Yeah, absolutely. Like Lightning certainly is. I mean, the biggest problem is like, as you say, like awareness of the reason why, right, is understanding of money, which I think like there's a big extent to which like we've never understood money, right? Like money has always been something that's like using us, or we've used it before we understood why it was working the way it did. But like, and this has started to get a little better because of Bitcoin. Like people have actually put some like deeper thought into the nature of money, but that that awareness needs to spread. And then the other thing is just like, is the volatility.
Yeah.
Right. The volatility is like the principal obstacle. Like Lightning could handle, you know, shit tons more activity. You know, the incentive and scalability are there, but like, are people going to use Bitcoin? And this is the thing where like, you know, creating a new chain does not help that problem, right? Because like Bitcoin's as big as it gets, and it still has this level of volatility. And anything that's smaller is only going to have more. So
let me make the counter argument to that. So what we need for the CDBC is we don't need BTC. We don't like, it's not necessary for us to transfer Bitcoin values. It's totally fine if we can transfer US dollar values. I mean, especially, I think just to like, you could say, okay, what about hyperinflation? I don't think the CDBC is going to hyperinflate. Maybe the old money will hyperinflate. I don't think the CDBC will hyperinflate, because why would anody like, why would you use it? It's going to have like a normal level of inflation, and you will be able to like keep using
I don't know about that.
CBDC
I
money.
don't know. Why would the CBDC have like any different like issuance or price dynamics than, you know, the non-digital central bank currency that it is like supplementing or replacing? I mean, like, you know, the economy that it denominates and the people issuing it haven't changed. Like the mechanism of distribution has changed. And so like some of the dynamics will be different. Maybe like, you know, the effects will be faster or slower.
Because of the incentives. The incentives are for to not hyperinflate it. The incentives are for it to inflate, right? Like maybe 5% per year, 2% per year, but not, you know, Zimbabwe 2 million % per year and so forth. And, you know, 5% per year, I can like, you know, if I just work, I can stomach 5% per year. I'm in Germany, right? Like I already pay like so many taxes. You know, like the inflation tax, it is a big tax, but it's something that like oppression wise, like, you know, how much boot on my neck, if it's like 5%, which is a very high inflation, you know, it's fine, right? It's not good, but it's bearable. But if you say, okay, why don't they just hyperinflate it? It's like, okay, but then why introduce it? Like all you do is like push people towards alternative currencies to use, and they're not going to hyperinflate at the same time. Like we already like looking into the Swiss franc, because, you know, the Swiss franc used to be worth less than a euro. Now it's worth more than a euro, and we're like, okay, maybe this is a better currency than the euro, and so forth. So I think the stability issue
makes sense.
Is
to be more robust,
solved
for sure.
Yeah, the stability issue is solved by the US dollar, which is probably like terrible from a BTC, and, you know, even
well, it's saved by the dollar oil relationship. Right, it's saved by the petrodollar.
Yeah,
because that provides like an implicit backing.
Yeah, so all you need is some way to put, and maybe it's not the US dollar, maybe it's going to be the ruble or it's the Swiss franc, you know, some kind of currency that people are able to use in commerce. I don't think it's going to be Bitcoin because it's going to be way too volatile. You know, if we need something right now to use it.
Sorry, do you mean in terms of like a stable coin that's run on the other one? Yeah, okay.
Yeah, it's good.
Yeah, well,
I think it's going to be a stable coin run on some layer. Yeah, preferably. I think it's going to be layer 1, because doing token stablecoin payments on layer 1, at least the way I've done it, is trivially simple.
Yeah, well, and I think that's also probably the pathway to switching over to like using Bitcoin or any native like blockchain currency like as a primary currency, right? Because like you want to onboard as much volume of monetary transaction onto the chain as possible, make it use the native asset, and then, okay, the native asset will have the requisite volume to lower its volatility and increase its value and so on. And then people are like, you know, they've been using like Bitcoin or eCash or whatever, like stable coins for a while. And they're like, well, like, why am I keeping like a Bitcoin and a USD B balance or whatever, when like the Bitcoin seems to be doing like better and better as something to use for money. And then they make that switch over. And like Taro, you know, I mean, or any, you know, whatever stablecoin protocol you want to talk about. And so in the case of Bitcoin, you know, I think that Taro on Lightning, which like I still need to like fully grok like how transfer of Taproot assets over Lightning is possible. Like I'm not as galaxy brained as Laulu is, so that's gonna take me a little bit to understand.
I don't know. Like I'm fine with custodial or centralized stablecoins, because you can, like, they're highly interoperable, especially if they're on the same chain, right? Like if someone launches a stablecoin and someone else launches it, then you could, like, you know, have like a network of stablecoins. I don't know how it's going to look exactly, but there's probably no way around that.
And they usually need to like have the money, right? Because we saw this with Russia, right? Like Russia had tons of dollars, like until they didn't, right? You need your custodian to not be subject to the same kind of risk. They need to have like, and I think the ability to actually hold like large amounts of dollars and not have them held like in trust for you by the Fed is like very limited, I think.
I agree. However, I think there will always be places where you can operate something like that. I mean, obviously the EU, America, you need, like, the EU law is crazy. What's it, MiCA, I think. Mike, I don't know how to say it. And so I think there will be other places. I've been looking in Liechtenstein. Theirs is also quite severe, but there's always ways to do it.
Yeah, and that's why, like, friends and I are down here in Central America in large part, like going to El Salvador, the charter cities in Honduras. Mexico is like, as a jurisdiction, is like not so accessible because they're just like more established than El Salvador is. But like,
and
just
I think that,
trying to, you got to build that archipelago, the network state.
Once you have the money, right? Once you have, like, let's say $1 billion or something, you can nudge politicians to be like, okay, let's just make this particular thing a little less regulated, right? Like, we just need this one kind of thing that's like not regulated and so forth. So I like the problem of having a custodial stablecoin. I don't think is too big, but then there's also other like protocols that we could use. We could use like the algorithmic stablecoins. I'm not like, they all seem to fail at some point. MakerDAO seems to like work somewhat, but they're just using custodial stablecoins as
MakerDAO is an interesting story because it was kind of swept under the rug that in the market crash at the beginning of COVID, like, DAI failed. It broke the peg, and they held this auction of Maker governance tokens to try to like shore up the value again, and it failed. Nobody bought it. And so instead, the emergency backstop committee of a bunch of ETH whales, subsidized them and bailed Maker out or bailed DAI out. It was reported as like the auction succeeded, and then you like read past the fold, like 3 paragraphs in, well, like no one purchased at the auction, but fortunately we had an emergency backstop committee that put in all the money instead. And so then they basically took over DAI from Maker, and the first thing they did was start collateralizing it with USDC.
Yes. Oh my God. Yeah, that's the number one now. Yeah.
2008. It's just fucking fake.
Wow. I know about this USDC part, but I did not know about this bailout thing. Yeah. And by the way, we have the same thing on, or not we, like BCH has the same issue with Flex USD now. But yeah, I think there will also come other innovations. So like there will be mineable stablecoins. Right, so I don't think you'll need any kind of like, you probably need an oracle for that, but that could be like distributed as well. And then like you can't redeem it, but it's going to have the value of $1 because it takes $1 to create. Right, so I think that will be incredibly.
Need, right? And that's all you need, really. Yeah,
that's all you need. And then maybe it needs a permissionless permission set of oracles or something to do that, but maybe you could also do it through incentives, right? Because mining is secured by incentives and so forth. So I think those will all be possible. And so that's why I'm working on, because imagine I go to my local grocery store, they're like, oh, our payment system doesn't work. Like, what do I need to put in their hand? If I put them like BTC Lightning, they will be like, I have no idea what this is. However, like what I built, these cards, they're NFC capable. This is a plastic wallet. Like, it has.
Dope. I've thought about doing this with Bitcoin. That's awesome. Yeah.
It has US dollars, like actual US dollars. I mean, on BCH, but this, I'm not gonna scale this on there. It has it on there. It works with, where is it? Like, I'm so glad I have these on the table. You tap it, you pay it. It does an on-chain transaction. It goes directly to the merchant's wallet, and there's no setup. I mean, the setup is you have to install the wallet and you have to get the point of sale. So you can also use a phone for that. Of course, there's trade-offs. You still have to like, you just have one. You lose a bit of privacy in this setup because you just have it in one UTXO. But who cares if it solves the problem of accepting currency without like a centralized party? Then you get get people using the technology.
Yeah, I mean, I don't think we should throw privacy trade-offs, out the window, right? I mean, I think this is the kind of thing where it's like, if you trade off everything for usability, then you also end up with like a version of the it's just fiat again fail case, right? Because I mean, I would not underestimate the ability of like major geopolitical actors to lean on little ones and on commercial entities, centralized stablecoin backers and things like that, right? And like, the more you lose privacy, the more you give those large actors like the incentive and the ability, to lean on operators for particular, like, censor these transactions, right? Because I know who they are.
But how do you censor a? So let's just for the sake of argument, say we have a mineable stablecoin, and let's say it's just a token on, let's say, eCash, or it could be Bitcoin, whatever, but an on-chain transaction, and you have a reasonable, and right now the blocks on eCash are tiny, right? They're way smaller than Bitcoins, but we can handle up to 32 times of Bitcoin, ignoring SegWit. If they have a, say, mineable stablecoin, and that they can use right away, why would what could someone do? How could someone censor that transaction? Like they could maybe 51% attack.
Really, if it's like layer one mineable, I mean, yeah, it would have to be like an attack on consensus.
Yeah, right. Like there's not a lot you can do on USDC. Different story, of course, but we're not talking about USDC, right? We're talking about something that is permissionless. Then I mean, I'm a fan of privacy. Don't get me wrong. I'm just like I'm just thinking it through. I'm just like, okay, what is the big issue if you have Bitcoin that you can just use that's permissionless? If you lose your privacy, if someone's like, oh, I saw you spend on this other store, I mean, and we can work around that, of course, like using multiple UTXOs and so forth. But in a very system.
So even censorship aside, right? I mean, like legibility is the problem. Right, because like the state requires legibility in order to exert force. It needs to know who it's targeting, right? And so if you even if it's not like censoring the transaction, it's like, well, now I know who you are, so I can come and find you. I can do something, like I can track you, right? Where this is the issue. We don't want like the state, the jurisdiction that we're operating in, to know too much about who's doing what.
I agree.
This is the lever that they can pull on.
Yes.
So,
yes.
Hold on, just like what I wanted to say.
Yeah, go ahead. Yeah.
There are cases, this is what I like so much about Taproot and about Lightning too, is like, I think it's a really good sign when instead of seeing something like a trade-off between privacy and scalability, you see something where the two come together, right? It seems to be as kind of like the golden era, like this is the right way, is like the rare cases in which you see something that instead of being a trade-off is like positive sum across multiple features of the currency that we want. So like specifically like privacy and efficiency. In the case of Taproot and Lightning, is that like you get less distinguishable transactions by making them smaller. Like you can do more, and by doing more with it, it becomes less legible. That's a really good sign. And like, it just makes me naturally prefer something that looks like that to something that like takes as its starting point, like we have to make a zero-sum trade-off or like a less positive sum trade-off between those desirable features, right? Because I'm just always wary of like, well, we're going to take as our premise that like, a ranking of which of these are important to us, and we're going to throw the bottom one to some extent out with the bathwater.
Yeah.
Right? Because like that's how we end up later down the line in a position that we did not want to be in.
However, I think the centralization pressure in Lightning will remove some of that privacy again. And if you route your payment through like a few actors which have a lot of liquidity, and of course that will be like that might be a way to generate yields, right? You just put a lot of liquidity on Lightning, and then you just track transactions. You just okay, from who to who.
Do you know about PTLCs?
PTLC.
Time-locked contracts.
I know HTLCs.
No, so this is using Schnorr signatures. So like it's a new construction that will be what comes after HTLCs, PTLCs, that would allow you to blind all of the steps in a path, along with some other interesting things. Like Onion. Yeah, like so no matter, even if you have like a path of 5 hops, like even if I own 3 of those hops, like I won't know that those 3 hops are transferring the same payment or who it came from. Yeah, but between each hop, that's really cool. And I'm glad we have that. What I think is like the way I approach things, because I'm actually building these. I need to build a business. I need to make money. How can I do that, right? Because things are gonna get dark soon. I mean, probably quite literally, given in Germany the energy prices and the stupidity regarding nuclear energy and everything.
how can I build something that I can use, where I can solve people's problems right now, like without having to do these all of these protocols, and they all have to, like, every time you add, like, okay, we add this privacy thing here, we add like this swap thing there, then the question is how do you find out where routes are? Like we have a lot of you have a lot of trade-offs, whereas on eCash right now I get instant transactions. I mean, like you could, right now they don't have Avalanche fully implemented, and but once that is there, you have, within a few seconds, you have full finalization, which is perfect for the, like it's perfect for online, but it's also perfect for offline, where like you go to a store, you want to buy food or something. And there, like Alex, he was in El Salvador. He was like, yeah, like there's technical issues, like you need to be quite savvy. Like I had issues with Lightning. It was fine because like the wallets usually abstract all of that away, but then it gets bit more custodial again, I guess. And then like the thing is how like, is Lightning really the thing I should like go to my grocer and tell him, oh, can you please accept this? Or should it be something that is on eCash, like that's a stable coin on eCash?
Yeah, and I mean, and obviously like the answer for me, like for a lot of reasons, is Lightning. And I partially, predicate that now, or like it bolsters that we have a pathway to doing stablecoin payments over Lightning. It's going to probably, take a year or two for implementation of Terra to come out, but like it's something that's available. But like I totally agree with you. Things like the reason, despite being like to some extent a Bitcoin maxi, like I'm down to like have this conversation, is because like you're right, things are getting dark fast, and like we can't be complacent, and too many people in Bitcoin are complacent. And it is also a road to trouble. So like, I think we have
that's why that's why we need these conversations, which I think is great.
Yeah, exactly.
Because like, you're telling me a lot of stuff I didn't know. Like I want to learn, and I'm, don't get me wrong. Like I like payment channels. I built a cool thing using payment channels because they're like incredibly efficient. Like if you want to do back and forth over and over, payment channels, of course. Bitcoin Cash had like this phase of like anything that looks remotely like Lightning Network must be evil. And I'm like, what the hell, guys? But yeah. But the thing is with eCash right now, my friend Cyprian, he is on Saipan. He is onboarding merchants to a stablecoin, and it's solving a real problem. It's they're using it right now, right? There's no like Terra or something that you have to wait for. And all of these estimates, like how long was ETH2, like how long did they estimate that? Like it's gonna be years still. Like I need something that I, I'm an engineer. I know how difficult things are to get going and to roll out and to make securely. So yeah, I'm that's does that make sense why I like, okay, I just want to pick what works right now.
Yeah, and I mean, obviously there's just like the meta level question of like, well, how much hash power is there on eCash? Like how many people are using it, and like is its robustness like battle tested and things like that? And that's like part of the trade-offs and like choosing, what to work on as well. Which like I don't like, where are you guys at, like global stats wise, kind of in like development life cycle with eCash?
eCash. So I don't know the hash rate currently, but I mean, we're like the current, like you can estimate it from the price, right? So the current price, like we didn't denominate it, but if we use the old denomination, so we can compare it to Bitcoin, it's around $40, whereas Bitcoin is 20,000, right? So it's around 500 times smaller. So the hash rate would be around 500 times, if my math is correctly, 500 times smaller than Bitcoin. So probably very easy to do a 51% attack. However, we are and here's the thing. We actually got 51% attacked after the fork because Bitcoin Cash was salty, right? Like we made changes to the protocol, and Bitcoin Cash was like, we don't like you, and they just wasted all of this hash power. I'm like, why? Like, which is like,
child.
Why? why? Like, just let us be. Like, there's a different, like, if at least you made money of this, but you're actually giving us money, because we eCash added a 8% rule, so that a miner would fund development, right? Like 8% of coins go to a treasury, similar to Dash, only it's not this Rube Goldberg machine, which just like everything is centralized. And they attacked us. But what happened is that we deployed an early version of Avalanche, which can be used to defend, or like which will be used to defend against 51% attacks. And that's where the proof of stake thing comes in. And this is, I think, where the system, even though it's quite small, becomes incredibly robust. So we don't need all of this hash power. We don't need all of that. And, hash power is a cost, right? Like can
you explain that? Because like Alex just sort of told me that it existed, right? That there's an early phase POS layer and that it has something to do with Avalanche, but not like, I don't know how like exactly how it works. Yeah.
I'd love to. So it's like so simple that I'm like, this works, but like the Team Rocket, they're called, they released the Avalanche paper, and it just works. Like, they proved it mathematically. And so the way it works is that you're a node and you're connected to a bunch of other nodes. And let's just assume, like, assume there's no Sybil attacks, and like every node has the same stake, and we'll introduce stake in a bit again. So what you do is you poll all your nodes, like you get a transaction, you poll, or in this case, you get a block. And this is what actually happened on eCash when that happened. So a node got a block, and then he also got a block from the attacker, and the attacker had more hash rate. But the attacker blocks came later because he was reorging them, right? But then the question is, like, first seen rule. Like, I just want to have whichever block came first, but you don't need that because it's subjective, right? Like, that node could have it first, that node could have it later.
Right.
So you get a block, and then you query all of the nodes you're connected to and be like, hey, which one of these is valid? Which one of these is the valid block? And then worst case, you get like almost an even split. Like maybe it's a little lopsided, right? Because the attacker is very sophisticated or something, but it's never going to be exactly 50-50. And if it is, like, I guess you pick randomly. So you're going to decide on the majority, right? Okay, like the majority is saying this block is valid. Then what you do, and also like people will poll you, right? People will poll you and ask you, okay, what is your which one of these blocks is valid, and you'll say whichever one you saw first, right? You saw the
right. So it's like which did you see first? So it's like, so the blocks first are querying each other about time series.
Yes, exactly. Yeah. It's a serialization process, right? Yeah. And that's what mining is also for, right? It's just about serialization, only it's very slow. Right. It takes like 10 minutes up to an hour or something. Yes. And with Avalanche, this is very quick, because all you do is like it's almost like in a, you just look at the people and you communicate this way, right? And you're like, okay, which one of these is it? Okay, it's that one. And then you change your own vote, right? Like, say you saw the attacker's block first, but like 70% of the nodes you're connected to say, no, it's the other one. Then next time someone polls you, say, oh, this is the other one. And if like the majority of nodes, or like if once we reintroduce stake, majority of stake says is honest, right? Because there's an incentive to be honest if you like stake money. Then you converge to like the correct, or like the actual first scene very, very quickly, right, within seconds, right? Which is why all of these like AvaX, I'm no fan of. Yeah. You do multiple rounds. Yeah, you do multiple rounds until you're like, okay, like, I mean, best case, everybody you polled gave you the same answer. Then you don't need to continue, because like, I mean, maybe you get a different result.
It seems like you could get like coarse graining outcomes where like different patches of the network would converge on different answers for the same attack attempt, potentially. Like, I mean, is there like an issue with like converging on a chain split where like one part of the chain, the majority of people saw the attacker's block first, like depending on, just like where the honest block is coming from and where the attacker's block is coming from, but even though the attacker's block, because it's a reorg, like in canonical global time, like, must always come later. Like, nonetheless, like, you could have a chain split issue where part of the network, because they were close to the attacker but far from the honest block producer, sees the attacker as being, not like they don't all see it first, but sees it as being 60% first or something like that, and the rest of the network sees it as, you know, the way it should be, and so you get a partition. Like, I assume that's got to be an issue in some cases, right?
There might be a pathological case where, like, you just happen to be, like, maybe the attacker also Sybil attacks, or maybe he locks up a lot of stake, but there's like a limit, right? Like, okay, I'm not gonna even participate in the system if I'm not connected to enough stake, right? Like, maybe you should be connected to at least, I don't know, a million, a billion, you know, pick any number, dollar value of stake, and then you run into the issue again. So what the attacker on eCash wanted to do, like, this was like how would you, like, spawn kill? Vitalik called it spawn kill, right? Where, like, okay, you start a new project and you immediately shoot it down. But we defended against that, and they look kind of stupid on Twitter. Anyway,
that's cool. Congratulations, though, not that it worked when they attacked you. That's based.
Yeah, right.
Yeah.
Especially if they're so childish, and the tweets are like, they're like an anonymous group, obviously, because, you know, they don't want to get sued. But all the tweets are still up there, and they're like very, very, like, sassy, right? Like, and then like through this process, because, like, this was almost like, I mean, we had to conspire a little bit there because we didn't want to give an attacker an advantage. So what we did, we established this. It was a preliminary, like a pre-version of Avalanche. So it wasn't like fully production ready. So what we did was just shared these proofs manually, right? We just gave them to trusted parties, which, of course, you know, you could say, oh, that's centralization. Yes, of course. But, you know, one defense against 51% attacks is coordination, right? Like, that's one way to defend against such an attack. And then what happened is that this mechanism, once it was established, worked so well that the miner continued mining like 100 blocks on his own chain without realizing. And 100 blocks at that point, that was tens of thousands of dollars. And there we could just see, wow, these people really burned a lot of coin. Yeah. And there I saw the incentives of Bitcoin. Like, I could touch it, right? On Bitcoin, you're like, oh, there could be a 51% attack. In this case, like, it's very theoretical because you're just the biggest guys, and, you know, that's good because you got the security. Like, you won't be attacked, and, you know, that's why I like Bitcoin. Like, I'm no hater of BTC. I just, you know, it's just for me, like, where should I put my time on? But there, I could, like, see it. I could feel it, and be like, oh, the attacker. Like, we could even quote the white paper. He ought to find it more profitable to play by the rules, because people will, like, we basically took his coins, more or less. Like, not really, we orphaned his blocks, and therefore all his blocks were considered invalid, right? So I think this is one way how you can how we will defend against 51% attacks. And then it's gonna be not like, it's going to take a while until we reach, like, similar hash powers to BTC, if even, right? And maybe we don't need to. Maybe BTC has, like, in my view, BTC has, like, too much hash power, because, like, then, like, the green people come, like, oh, this is evil, which I don't agree with at all. But
we tracked a new kind of social layer attack.
Yeah, exactly. Like, you create a little bit of like, it's not a big vulnerability, but there's a lot of people who are like, oh no, we need to use proof of stake, who's true to say that because Bitcoin is bad for the environment. Anyway, I'm not saying Bitcoin is bad for the environment, but there are people who say that, and it's bad for our electricity bill though. And yeah, so and with eCash, you still have proof of work, right? Like, all coins are created by proof of work. I mean, of course, we got the 8% rule that goes to the developers, but that's also proof of work because, you know, they're writing the software to some extent.
I mean, it's just a different type of block subsidy, right? You know, like, whatever.
Yeah, exactly.
I don't really have any issue with, like, development funding, because, like, you know, your only options for funding development being, like, either, like, you know, number go up or charity is not a good ecosystem dynamic, you know, unfortunately. But Which this is just so like proof of work miners also have to stake, and they stake basically in order to participate in Avalanche pre-consensus.
So that would be post consensus. So there's two parts to that. So pre-consensus is basically Avalanche on transactions. Post consensus is Avalanche on blocks, right? And like I haven't fully understood why we need both, but apparently we need both. The way Amri explained it to me is that basically, like if you understand pre-consensus, so pre-consensus is why we get the instant transactions, right? Because like just like with Lightning, Lightning has instant transactions. Layer 1 on Bitcoin does not have instant transactions, very far from it. But we want instant transactions on eCash on layer 1. Therefore, we establish pre-consensus, where basically once you get a transaction, you poll your nodes. I mean, okay, is this like which one? Like maybe you get two conflicting. Which one of these is the valid one?
Right. Is this valid?
Yeah. And then what you do as a miner, you will orphan blocks that don't obey the result of this process, right? You will be like, with the pre-consensus. So say you get a transaction, you vote on it, and then some miner mines a conflict of that transaction, like something that a double spend, like you mine a double spend of that transaction into that block. Then you don't get other miners will be like, no, this is invalid, right? You're not following the correct rules. And therefore, it's very important for miners to participate in both pre and post consensus. I mean, pre-consensus because they need to know what's the truth, right? Like what's the current state. And post-consensus, of course, because then it's like an arms race, right? Like
the usual like elimination of blocks.
Yeah. Like so that's the mechanism there. So that's a mechanism. Really... Right? It's a totally different system to Lightning. So you must be like, okay, like a whole new world. Also, like with this Project Hamilton thing, which like it's kind of like for Amory, it was like both good and bad. He had, when he read the paper, it was like he gave him a good feeling and a bad feeling, because he was working on like Bitcoin Cash on a system that looks almost exactly like what they did, because and here's the kicker, the people working on the CBDC on the Federal Reserve are Bitcoin developers, actually. Like a lot of them, like you can look it in the white paper. Like Corey Fields most prominently. And he didn't commit that much recently, so he's not that much of a Bitcoin developer anymore. But it's just sad for me to see these people do that, and that's why. And you can understand it. Like everybody has a dollar sign. If the Federal Reserve would be like, okay, we give you $1 billion in order to build a CBDC, I'd be like, I could do a lot of good with $1 billion, right?
Everybody has a price. Yeah,
everybody has a price. So I don't blame them. It's just like. And no fault, like and maybe he should be called out or something. I don't know, but don't no hate, please. But like I understand why people would do that, and sometimes it's just like this. Like for Amri, it seems self-evident. Like no, like you want to build something that's cool, right? Like imagine you build a CBDC. Isn't that cool? Like isn't that a cool technical feat? But if you have like if you want to have more than that, if like no, like I want to have something that's like something that's proper good money that you can use. Yeah, that's good.
Not evil. Yeah.
If I want to be on this good side of the good guys, then then that's not an option.
Yeah, it is like something really surreal about like a UTXO model hosted on an AWS instance.
Right?
It's
like,
run by the Federal Reserve. That is bizarre.
That's bizarre. Yeah. But it is because the UTXO model turns out to be so scalable that of all the possible options of everything the Federal Reserve could have picked, account model, some whatever model, the UTXO model turns out to be the most scalable. And that's why I'm like, okay, let's scale eCash as much as is feasible. And we can quantify that, of course. We can be like, okay, how much does it cost to run a node? right? And we can be okay. It costs like, I don't know, $100 per month or something. I mean, right now it costs like nothing to run an eCash node, obviously because it's empty. But a Bitcoin node, different story. It's not for free. But what if there's a sustained load of like, I don't know, 100 megabyte blocks on eCash? Then it's going to get costly, and we can quantify that, right?
Yeah.
And also, like, there's this BSV attitude, or I think BCH also has that of like, oh no, like any transaction goes. I'm like, there should still be like a mechanism where like you order the importance of transactions, right? It's like, okay, like if you have a transaction that costs 1/100 of a cent, this is what it probably currently costs on eCash, like very, very low. In my view, way too low. Like this is unsustainable. But like there will be a lot of transactions that are not really important on the chain, right? However, if it costs 1 cent per transaction, which is something that's like very, very cheap, right? Or maybe a tenth, something like that. Very, very cheap. So you don't really notice it when using it, but you get a very, very different set of transactions on the chain.
Right. At least like, at scale, a Sybil attack becomes expensive. Like there's some kind of pressure not to do that. Yeah. I mean, market forces are good. Like this is why things have prices, right? Yeah. Trying to avoid scarcity, like, in order to avoid having price signals is, I think, a degenerate path towards scaling.
Yeah. Bitcoin is not secured by cryptography. It's not secured by software or something. It's secured by incentives. That's why it works.
Exactly.
So yeah. I think we found a nice conclusion point there, just hitting almost the 2-hour mark. Where can, like, I hope people didn't find this too technical, but we went deep, man. We went very technical compared to the, but I love that. I really enjoyed that conversation.
Yeah, same.
Yeah. So where can people find you? Are you on Twitter, on, I don't know, maybe you have something equivalent like Twitch?
I have an account on Twitter. I don't know if I would put it in a podcast. Are you on Urbit by any chance?
I am not, but you can say your Urbit and then I put it in the description.
Yeah, it's Tondas Sitrime is my pat P, or I'll put it in chat. That's my.
Can you put it in Telegram?
Oh yeah, sure.
Because then it's stored forever.
Okay, there it is. And then
Perfect.
my Telegram is like real name. Cyclomancer is my Telegram handle. So anybody can reach out to me, but no, I'm not going to invest in your shitcoin.
Please invest in Luna or whatever. Celsius needs your help. Bitcoin Cash, go for it. Oh, by the way, I recommend you watch the video, the interview I did with Vinamani on. If you like to see Roger Ver crashing and burning, there's a good video of like the whole retelling of the story of my side, right? Like the history of my side.
Yeah.
Of course, a little biased, but and I think it's, like some things are like, that's a little speculative, but speculation is always like hindsight, But yeah, I recommend that, and yeah, also read more of the Project Hamilton paper. I think it's really cool.
Yeah.
It's well written.
Yeah, if you want any like Taproot related resources, let me know.
Yes, send me all the Taproot stuff, because like I'm also working on a different blockchain. Oh yeah, I didn't talk about that at all. Lotus, and there it has actually a mining stability mechanism. So it's like a soft stable coin, but on layer 1, like the coin itself is a soft stable coin. Givelotus.org. Okay. I can also give you some pointers there, and maybe we can like maybe that system gets us something that is stable, and it's basically a fork, like a software fork of eCash. So it has a new Genesis block, but because of like we don't have 21 million because we're a kind of soft stable coin. Yeah, and the incentives there, of course, totally different. And that. There I added Taproot, like a basically backported BTC's Taproot, because I just found it so cool. So cool. Any BTC resource you can give me, I'm like, okay, like we could probably use that on Lotus. So yeah, I'm very, very interested in that. And generally Lightning, because I need to, Sun Tzu, know your enemy like yourself or something. I don't consider BTC as the enemy, but I need to be aware, right? Yeah. Thanks for that. Thanks for that conversation. And you have a great day.
Yeah, likewise.
Bye-bye.
Bye, man.